So we can look at a basic question on group accounts. So maybe try to take a snapshot.
Okay.
Let's do like this.
And what?
Okay. The question reads, Mateo purchased, is it this one? No, not this one, not this one. Not this one. This one will be looked at later. Let me just share another one, sorry. So take a snapshot of this.
Okay.
And down here. I guess you have done?
Yes, we've done.
Okay.
At the upper part, yeah.
Okay.
Okay.
So the question reads, it is anchored, basically it's just anchored on what we looked at last time we met. It just builds on the same principles. So I thought maybe first we look at this example, then we go into the nitty-gritties. It reads, on 1st January 2023, Goodwill Company acquired 5% of the share capital of Movita Company for 1.380 thousand. The retained earnings, sorry. The retained earnings of Movita Company at that date were 480,000. Movita Company's share capital has remained unchanged since the acquisition. The following draft statements of financial position for the two companies have been prepared at 31st December 2009. So we have the balance sheet. Then down there, we are required to compute the goodwill arising on acquisition of Movita. So we'll start with goodwill first. So here we know in principle, we know the fair value consideration, how much Goodwill paid to buy the 5% shares in Movita, which is 1.3. Then we also need to know what was the NCI at acquisition. So definitely it should actually be 25% of the pre-acquisition assets in the subsidiary, in this case in Movita. Once we have those two numbers, we will be able to determine how much was paid to Movita in buying all the 100% shares. That is the 25% shares from the non-controlling interest and 75% shares from the parent company, in this case, Goodwill. We know for a fact that we do not have the intelligence to determine the actual payment that the non-controlling interest paid for those 25% shares. So we can use the proportionate method or the fair value. So in this case, if we are to use proportionate method, then we'll just look at the net assets at acquisition times 25%. But thank God, we are given the fair value of the NCI, which in this case is 450,000. So our work becomes pretty easy. So once we have those two numbers, the 1380 plus the 450, whatever total we get, less the carrying amount at acquisition. So that difference will give us the goodwill. Sidney, are you getting me?
Sure.
Ernest?
Yes, I'm getting.
So then now we can go to the calculations. Go to the whiteboard. I guess you are able to see the whiteboard.
Yes.
Sure.
Technology has become much easier now. So we'll go for the goodwill. So we'll start with the cost of investment. Cost of investment or fair value consideration. We can just put FV dash consideration, the actual amount that was paid by the parent company, in this case, Goodwill. We found that it was 1380.
Yes.
So I'll put 3 zeros here. I would equally raise 3 zeros there. So we'll have 1380. Then what was the NCI at acquisition? We've been given that number as well. How much was it? Sorry, my internet is not stable. It's not stable. It means I have to restart this thing again. So we start with cost of investment. Since we are looking at goodwill, good morning. I guess you have already gotten the goodwill, guys. I guess so. So we have the 1380. Then NCI at acquisition.
NCI 450.
150,000.
450,000, sure. So how much is the total?
1830.
1830. So we go to the net assets. So with the net assets at carrying amount, what was the net assets? We have the equity, which was 1,000. Then we have at the time of acquisition, what was the retained earnings? So we have the share capital. Under net assets, we have the share capital of how much? You get the share capital for the subsidiary. Then what was the retained earnings?
660.
No, 660. It actually contains, that is at report date. It's both at acquisition and post-acquisition. We want to only get the retaining earnings at the time that we're striking the deal. How much is it?
Share capital. 48.
It is 480, yes. Because that is the point at which you were. So how you're getting that 480? Don't guess what it is. You have important dates here. The date at which date at acquisition, that is the date that you have. Then you have another date at report date. I'll do like this. I'll say report date. So at report date is basically what you are able to see in your financials. So these balance sheet values. So when you are looking at goodwill, we concentrate goodwill concentrates on this. All events happening happening at acquisition. Those are the things that you factor in, the variables at acquisition. Those are the things that you factor in your computations of goodwill. Children, are you getting me?
Sure, sir.
So that is what you look at. Thank you. So we get 148, which then gives us how much as goodwill?
$350.
350.
350.
This will be our goodwill. Is it okay?
Sure.
0977 747 86 74. So, Ernest, we then now go to the second part of the question. I'm teaching, you're disturbing me. You ask mommy how to say. So we go to the second part of the question, which is calculate the non-controlling interest at 31st December 2029. So how much would be our non-controlling interest? So we get back to the question again. This is part B. So in calculating the NCI, there are also two things that we have to look at. We'll have to look at acquisition and we'll have to look at post-acquisition. Those are the things that we have to look at. So meaning at NCI, at acquisition, how much was it? How much was it at acquisition? Check on the question, guys. You have the numbers. At acquisition, you pick the same figure that you have in your Goodwill Computations. Sorry, my internet is not good, but we'll persevere.
Sure.
Certainly persevere. So, NCI at acquisition
Yes, 450.
Mhm. You always need to pick what is in your Goodwill computations. What you have put in your Goodwill, that is what you bring in here. And it's true, it is 450,000. So the NCI at post-acquisition, basically is your profit. What was the NCI at post-acquisition? So here, the way you compute this, Sidin, is easy. You look at the RE, which is retained earnings,
Yes.
in the balance sheet, which is basically at report date, at RD, less retained earnings at acquisition. Which the examiner will give you. So this difference, basically, it shows you the post profits, which then you multiply by the NCI percentage. So what was the retained earnings in the balance sheet? How much was it at report date?
660.
So you have 660. Minus at acquisition, what was the retained earnings?
Retained earnings at the acquisition.
You have it in your Goodwill computations.
Retained earnings, there's 480.
480. There's 480. That was your retained earnings at acquisition.
Yeah.
Giving you how much?
180.
180.
So find 25% of 180.
45.
45.
That is what you're going to put there as the post NCI at post acquisition. Then you add the 450. So you're saying it was how much? 45?
45,
Yes.
yes.
Which gives you 495.
95.
Get money. So this was question B, I guess.
Yeah.
Question 1 is on investment. How much investment? And first read the question. Read the question first. Read the question. It says, calculate the following figures, which will be reported in Goodwill's consolidated statement of financial position as at the 1st December 20X9, investment. So how much do you think will be the investment in the consolidated financial statement? Read the question and give me the answer. Follow the principles under IFRS 10. Which we looked at together.
10.
I'm giving you a minute to discuss. I'll come at 8:01, somewhere there.
So, Mr. Ernest,
Yes, my friend.
yes, the investment, is it not 1880?
It should be 1830.
Someone remove your shoes from here.
1830 should be because the cost of investment, there's 138.
How much is the investment? I know you have reached some verdict of some kind. How much is the investment at consolidation?
Because we looked at what he acquired, the 75% of investment he acquired was 1380. Now we see the other controlling, non-controlling interest here. That's where we are stuck.
Guys, the question is, calculate the following figures, which will be reported in Goodwill's consolidated statement of financial position. At consolidation, if this goes, you will know that this goes. So it will be new. You can't put it in your consolidation.
Yeah.
Hachof, are you getting me?
Yeah, I'm seeing. Okay.
So an investment in the consolidation, consolidated financials, it should be new, very new. Nothing. So at consolidation, I want you to give me other assets. Hello, Sydney, have you gotten it? Under investments, that's what we have discussed so many times. This is guided by IFRS 10. We are not going to show anything under investment. That goodwill you computed was in a way to remove this investment. Okay. Consolidation.
Okay.
So if you really don't, you are not under the hands of a coach, you start putting the figure. You see?
Yeah.
Yeah.
Other assets.
So I want you guys to compute the other assets, the share capital, retained earnings, and the liabilities. I'm giving you 10 minutes to finish up this thing. Then I'm going to verify to see whether you still understand the principles they are in.
Okay.
So on other assets, we know that it's 100% the subsidiary and 100% the parent company, which gives us how much? For the other assets, to be 4,500.
Yes.
Plus 2,400, right?
2,400, yes.
Giving us 6,900.
6,900.
You got it right? Did you?
Yes.
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 Right. Right.
Then share capital. What story do you have on the share capital?
Get the one from the parent.
Yes, you only pick from the parent because the other component has already been included in your Goodwill computations. Remember, when you are actually canceling off the investment, which is actually sitting the parent company, you also cancel off your equity. Under equity of capital, you have pre-acquired reserves and all that. So those they get canceled for you to, any difference between the two, it gives you your goodwill. So in share capital, you only pick for the parent company, which in this case was how much?
2,000.
2,000, yeah. On the retained earnings, you pick 100% from the parent company, and and you then pick the post-acquisition portion of the parent company.
Yes. Okay.
This is very
Retained earnings. So you had retained earnings from the parent company. How much was it?
2,040.
It was 2,040.
Yes.
Plus, we'll do like this. The post-acquisition profits, guys, was how much? So 660 minus 480, how much was it?
It was 180.
180?
180.
Yes.
So 180 times 5%.
Percent, yes.
Right. Yes.
We have yes.
Remember that the 25%, if you still remember, it was under the NCI on post-acquisition, which was 45. So in short, it's just 180 minus 45 plus 2040. How much you get in total?
258, 2175.
Yes, 2175. You got it right.
Great.
Then liabilities.
But at the confidence,
It's about confidence. It's about instilling confidence.
Yes.
So on liabilities,
also 100.
You
also
had
100%.
from the parent company, which is 840, 100%. Subsidiary also will be at 100%, which is the 740.
Yes.
Giving you how much?
2580.
2580. Congrats, gentlemen. We now move to another section. of the group accounts. So it's basically the concept that is very, very important. So we then go to other reserves, but just know that the computations on other reserves is similar to the one that we did under retained earnings. The principles are the same. So each reserve has a separate calculation. What we mean, if you are looking at the retained earnings, it has a separate computations. If you then go to revaluation the reserve, it will also have its own computation. But the principle will always be that you pick 100% from the parent company and pick the post-acquisition revaluation reserve, only that portion that belongs to the parent undertaking. So the principle is the same. You get me, Sidin?
Yes.
Mm-hmm. So then now we are going to go further and look at a methodical way of computing, of working out a consolidated question. About price weighting, which can be extended to speak when you're actually looking at other components, such as for the associates and the like.
Okay.
So the first working, which is almost given, you could earn yourself a half mark if you do it correctly, because it's very easy, is on the group structure. You first need to know the group structure. How much is going to the parent company? What percentage did the parent company acquire? The percentage of shares did the parent company acquire from the subsidiary? In this same relationship, was there any component from the associates? How much worth of shares did the parent company buy in another company, which is less than 50% and probably higher than 20%, which gives the parent company an associate status? So that's the first part that you have to look at. You have to come up with a group structure. The second component, computations, would be on the net assets in the subsidiary. You may be wondering that when you're looking at the net assets in the subsidiary, you are focusing on the equity component, which is too correct because you don't want to pick those assets. The equity component is basically the net assets. It's net assets because then you're actually looking at the total assets less the liabilities. It gives you equity. So this is the second computation, and you have to write it somehow. The net assets of subsidiary. So there are three positions in here. The first column represents at reporting date. This is what you are able to see on the balance sheet. Whatever is on the balance sheet, that is a representation of the report date, at report date. So this component, I always say, do not even memorize it. Just pick all the elements you find under equity. Pick them as part of your schedule. or schedule. So you have at reporting date, at acquisition. This is the period at which you were actually striking a deal. When did you finally acquire the shares in the subsidiary? That is what at acquisition represents. How many shares were there? Was there any share premium? That SP is basically share premium. What was the retained earnings at acquisition? You have to show that. Then the post-acquisition would be the difference between the report date and that acquisition. So that difference, it will sit under post-acquisition. Sidin, you get it?
Yes, I'm getting it.
So we're saying when you're actually looking at a group accounts or consolidated question, there are three events. The first event is, when did you acquire the shares? The second event is at report date. What is in your financials? The third event is what part of equity or net assets is attributable to this parent company running the subsidiary or managing the subsidiary, or at the time that the parent company had significant control over the subsidiary. How much net asset did they grow? So you're looking at value creation. You get it?
Yes.
So we might actually use this methodical approach to compute the things that we have looked at there under Goodwill and NCI, just to give you an idea of how it can be done. This component of the group accounts computations is very, very important, because it's from here that we are able to compute whatever you get here affects your goodwill computation. This is what you get. This is where your NCI at acquisition So all you get, you get the percentage, the NCI percentage. So this NCI percentage, whatever you get, this is what goes in the goodwill, sorry, just below the fair value consideration. It is the same amount that actually goes in the NCI computation at acquisition. Then this amount as well, this is actually used in your GRE, which is your group retained earnings. It is also used in the NCI, which is basically post-acquisition. And we know that this component is basically used to compute your post-acquisition. so that you have at report date less at acquisition. That value addition, which comes in after you have significant control as a parent company, has to be computed. And you need to master this methodical way of doing things. The third computation will be on goodwill. Goodwill then becomes much easier because with your goodwill.
Yes, bro. Yes, I'm sure. Yeah. In financial reporting.
So with goodwill. So with whom are you talking to, Ernest? Tell him that you're in class.
Yes, yeah.
Are you at the office?
Yes.
Oh, okay. Pass my regards to whoever knows me there.
Okay, is our engineer here? Just came in and I'm checking for something.
Oh, okay.
Mr. Muero.
Okay. I doubt if I have met him.
Okay.
So on goodwill, remember that when we go to the third computation, I'm just giving you a preview of what we'll be looking at. On goodwill, we normally pick the fair value of consideration, or what you actually call cost of investment. Then you pick this percentage here on the NCI, then less the net assets. This whole amount goes in and sits as your carrying amount. It sits as your carrying amount. Remember what we are computing when we were computing goodwill, the 1,000 plus 480. That is the net assets that is going to sit here. So before we go to the goodwill, let me just, using the same example we looked at, if we are to put it in this format, how is it going to look? If we are to use this methodical way of working out a goodwill computation question, this is how it's going to look. You will start with working one, which is group structure. So with group structure, we are actually saying the parent company gets 75% in the subsidiary. Here I can show subsidiary. Whereas the NCI gets 25%. That is how it was structured, isn't it?
Yes.
Then working two, this is where we're. Working two is net assets in subsidiary. So the net assets in subsidiary, we said there are three columns that we have to open. We have to actually look at reporting date, at acquisition, and post-acquisition. So we had equity, we had share capital, so share capital at report date, what we are able to see in the balance sheet, those 1,000. Then we had a retained earnings, which at report date was 660. At report date, we had 1,660 as the book value. Then at acquisition, this was to 1,000, giving you post-acquisition nothing. Then here you had, is it 450 or 480? Is it 450 or 480? It was 480, right? 480, the retained earnings. 480?
Retained earnings, yes, it was 480. Yeah, 480 at acquisition.
So which gives you, at acquisition, it gives you 1,480. Whereas this side, it gives you what is the difference? Is it 180? Right?
Yeah.
180.
Which at post-acquisition, you had 180. So this schedule, or schedule as you pronounce it, as you say it, we know that from here, this is where we're going to get our goodwill. The inputs for our goodwill computations will actually come from the net assets and subsidiary schedule. The inputs for the NCI will come from this schedule because we'll pick at acquisition and post-acquisition. Just those two. So this schedule seeding is very, very important for you. Is technology making sense? Is technology making sense to start with?
Yes.
Sure.
I see training people online. It is even more beneficial to students than going into class because there's this one-on-one. It's more or less like a one-on-one.
One-on-one, yes.
Yeah.
Yes.
So we got working 3, which is goodwill. So the goodwill computations, which you have already done and familiar with, we did mention that here first you have fair value of consideration, shares. This is given in the question. You'll be told how much you paid. This is basically from the parent company. Then you have the NCI at acquisition, which you're actually going to pick from working 2. In that schedule, under at acquisition. Similarly, this one, you pick it from schedule 2 as well, and you get your goodwill. So we go to goodwill computation. So we start with fair value consideration. Or cost of investment. Which in this case, it was, I think, 1380. Right?
Yes.
Then we have the NCI at acquisition.
Okay, sir. Okay.
So the NCI at acquisition, this is where you pick it from working two. So here you have the at acquisition, which is basically your NCI at acquisition was it was 1480. So from this 1480 times 25. But again, you need to know that what takes precedence is the fair value. So NCI fair value here, if we are using proportionate, this is what would pick. So if it was proportionate, then it would be 1480 times 25%, which gives you how much?
$370.
Yeah?
370.
So if it was proportionate, you would get 370. But then you have at fair value. But then this one,
Yes.
so you do like this, you ignore it, you look at fair value. Because this is what you have been given. How much is it? 450?
450.
Yes.
Giving you how much in total?
$18.30.
Yeah? It can't be 1330. Or 13?
18.30.
1830, like this?
Yes.
Then now, less net assets. This is basically at acquisition, because you never had, at post-acquisition, by that time, you didn't even know what was there. So the net assets at acquisition, you pick it, which is this 1480. Those are the net assets, 1480. Giving you how much as goodwill?
$350.
350. This is how,
350.
yeah, this is how you compute your goodwill, by using this stage, a structured way of tackling a consolidated question. Sidney, I hope we are learning.
We are learning. Actually, fair value takes precedence.
Yes.
That's a learning key.
Yeah, definitely. Okay, so we go to. So after working 3, working 4 is on NCI. Again, what you do is that you pick the NCI that you have in goodwill, under goodwill, sorry. under Goodwill. This is the NCI that you're going to pick. So it will definitely go, it will go to working for. Then so that will go to working for as NCI at acquisition. Then you're going to have at post acquisition, which again you go to working to under post acquisition. That's 180, and you just pick your part, which is in this case is going to be 25%. So here now from the NCI, you're actually picking, like I said, you're picking from Goodwill. You're also picking from working to under the post acquisition. So this is what we're going to do. We have to go there. We have to go to the whiteboard. So meaning on the NCI, one will pick at acquisition. So at acquisition, we already have the number, which is for what? Is it 450?
450.
450.
450, yes.
Then post acquisition, so with the post acquisition, we'll go to working to, which is the 180 here, times 25%. Giving you how much, Sidin?
45.
Giving you 45. This is your, how you got your 495. So please do not forget this methodical way of approaching a consolidated question. So the working for, is it working for? Working 5 is on the group retained earnings, which I know that you are very, very much familiar with. So this one would be obviously 100% from P, which you find it in the balance sheet. Then you actually pick the post acquisition. You only pick a share of the parent undertaking. So we go there.
$2,040.
Oh, group retained earnings, sorry.
That is right.
Huh? Sidin, I can't get you.
No, I'm good. I'm good to go.
Okay. So group retained earnings. So on group retained earnings, you pick for P, which is basically all. It shows how much for the parent company, guys?
2040.
2040.
2040.
Okay. Then for the subsidiary, you only pick P's percentage. So you go again to working two. Working two is very, very important, which is basically from here. So under working two, it gives you NCI, and it also go to group retained earnings. So we have that 180 times 75%. Which gives us how much?
135.
Which gives us 135.
Yeah.
Getting a total of how much?
To 175.
175.
175. So using this structured way of computing goodwill, of computing consolidation or tackling a consolidated question, you'll be given a question here, which you need to work out. I'll give you maybe about 30 minutes or so to work out using these group weightings, using this methodical approach. Then once we are done, we can.
We are not getting you.
Okay. Let me do this. There's someone calling. Let me just speak. Hello, Simpito. Okay. Okay, so what I was saying, I'll give you a question here, which you need to work out. You look at all these 5 stages. Then later on, you can do the consolidation. You can even do your consolidation. So this is a question that I'm giving you here. You had already done, even gotten the snapshot for the first one. That was the first one. So the question reads, Mateo purchased 80% of Jumbo for 600,000 kwacha 2 years ago, when Jumbo's retained earnings showed a balance of 100,000. You have the balance sheet. Then down there, additional information. Mateo measures the non-controlling interest using the fair value method. The fair value of Jumbo's equity shares acquired was 200,000 at acquisition. Prepare the consolidated statement of financial position for the Mateo Group for the year ended 31st December 2022. So I'm giving you about 20 minutes to finalize this question.
Okay.
Thank you. So, Mr. Ernest,
Yes.
the best is to read the question again. Yeah,
Oh,
we
yeah.
are told, yes, we need to start with the structure, isn't it?
Yes,
The group structure.
Yeah, we'll start with the group structure.
As working
Which
one.
is as working one, yes.
Working one. So definitely the parent at 80%.
80%, yes.
For 600 2 years ago, when the Jumbos retained the earnings, it showed the balance of 100,000. So that's a group structure. We need to just to draw.
We draw a group structure, then
Yeah.
from there, when we move on to the next one, that's where we'll do structure. Parents 80%.
80%.
So I 20%.
20%, yeah.
Yes.
Yeah.
Okay.
So this man is Mateo Jumbo.
See. So we can now to the net assets, eh?
So now we go to net assets in subsidiary. So we do that diagram.
A diagram, yes.
Okay. Net assets in subsidiary.
Report date, acquisition, and post-acquisition.
So report date, acquisition, and the post-acquisition. So we start with the shares, share capital.
Yeah, share capital. Share capital. What your purchase for 600 years?
Share capital. So this man, share capital is how much?
Share capital for the subsidiary, it was in at report date. We start with report date. The share capital is 200.
200,000.
Yes, 200,000.
Then at acquisition.
At acquisition, share capital.
100,000.
Net current asset.
It was 200. Equity shares.
Yes, at report date, there was 200,000. You see from the 200,000. Then,
yes. But if you look at down there, additional information.
Yes, my term is not the fair value. The fair value.
Equity shares
acquired 200 at acquisition.
So this is never changed.
Yeah, this one is okay. We'll leave it. Is the fair value? When you come to the fair value at acquisition, because this one,
So
the one at
never changed.
What of this one? Because this one is at what? Matthew was saying 2 years ago when Jumbo retained earnings, it showed the balance of 100. So retained earnings at acquisition already is given. Retained earnings at acquisition. We just slot in
wait a minute. We are still at share capital at that. We are still at share capital.
So, it's better we slot in with the ones we are very sure. We put
okay.
Then earnings. Kai is saying from the total, Mateo purchased 80% of Jumbo 600 2 years ago. When Jumbo's retained earnings showed a balance of 100,000. So at acquisition already, we can just put 100 somewhere. 100,000.
Those are retained earnings we're talking about.
Yes, so I'm just putting in the blanks. As I'm reading the question, I'm picking to slot in this.
Okay, so we go to the retained earnings.
You can put that figure we are sure of.
Okay, retained earnings at the report date was 400.
Yes. 100,000.
And the at acquisition,
Acquisition, 100,000.
and the acquisition retained earnings was 100,000. What else do we have?
So what we have, the
I don't know why you're scared of using 200,000 equity shares.
200,000 at acquisition. Yeah,
If you
I
go
think
to a
that's
different
just, yeah. Okay, when put at acquisition,
so there was no difference.
there are no difference.
So it's the same dash.
Yes,
It's
yes,
200.
right. Material measurement control favorable with jumbo equity shares acquired was at acquisition. Oh. But it is simple ngavamipera, so not power difference. It's okay. So I think we'll ask him at what point he change. So what else?
So yeah, also 200. Okay. So we go to working 3 goodwill.
But before we go there, then now we at report date retained earnings was the 400. Then at acquisition, it was 100,000. So we can get the post acquisition first before we go last, which is the post acquisition will be what? Will be 300.
No, where are you?
I'm on retained earnings, the line before we go to goodwill. There's
Okay, the retained earnings, we saw that it was 400.
Yes, at reported date. Then
Yes.
at acquisition, there was 100,000.
So the difference is
300, you can get post acquisition there.
300.
Yes. Okay, there. Can you close, Can you close?
So go to goodwill.
Go to goodwill, yes.
So under goodwill, we are told that the fair value consideration.
At fair value, yes. Okay. At tax precedence,
Fair value consideration.
Uh,
They bought it at how much? 600, isn't it?
Yes.
600,000. Then they are saying that NCI acquisition. NCI acquisition.
NCI, yes. NCI.
NCI at acquisition, isn't it?
Yes.
So what did we do? NCI, we take the fair value. The fair value has been given as how much? 200, isn't it?
The fair value, yes.
Jumbo's equity acquisition at fair value was 200.
Fair value consideration, okay.
You remember the NCI at acquisition fair value? Fair value.
Okay, I'm just a moment. Fair value consideration of put, and then NCI. NCI. Get You remember in that question we are given we had calculated the NCI.
No, not yet.
Yeah. So now what to do from the let me just get the 450. The way we came up with the 450.
450 was given in the question.
Yeah, it was given. Now it's not given. So
It's given now. We are given 200. The fair value. If you look at additional information on the screen.
Yeah, I've seen. The fair value. Yes, we are given. But I mean now to get onto the NCI. Okay, we have to add fair value consideration 1380. Then that is 1380 in that other question. In this question, the fair value consideration was the amount in which they paid. So in this case, we have a 600, which he paid, yes. So now the next point to get that's where maybe we now consider the proportionate now on the net assets.
There's no proportionate here, Tata. Here you have been given a fair value. Just like you were given a fair value from the other one. That time the fair value was under notes, which was 450. Here the fair value is 200.
Oh, so okay. You know what I'm coming at myself. After the consideration, fair value consideration, which is 600. Have you seen? Yeah. The next from the fair value consideration to get now the net assets. What do we do?
So we get the NCI acquisition using the fair value, which is 200. So you add the 600 to 200, which is 800. 800. Are you there?
Yeah, I'm getting you.
So now from there, we need to subtract the totals in terms of net assets.
Okay.
The difference is what we call goodwill.
Okay.
Just verbatim the way we got the first one.
The first one.
Because I don't say that here, if you look at the acquisition in terms of the net assets, in the subsidiary, we got 300. We got a 1480, which was in the middle here at acquisition. Here, what is in the middle is 300,000. So
okay, let us come your route. Okay, let us come. You say it's 800.
Okay, let's start from the first one. Fair value consideration, you have no issues, isn't it? Which is 600, right? The 600. Then NCI at acquisition, you go to the notes. Mateo measured the non-controlling interest using the fair value method. Fair value method. The fair value of Jumbo's equity shares acquired was 200,000 at acquisition. So you put in 200,000 at acquisition. The way we had put it, that one, the 450, you remember the last question?
The 450, yes, okay. So it comes to 800.
Yeah, it comes to 800. Then we say now, let's see, assets, net assets.
Net assets.
From working is number 2. Which is 300,000, isn't it?
Yeah.
So if you subtract from that one to give you 500, which is goodwill.
300, 500. Okay, goodwill.
No tricks here.
Okay.
So we go to working is number 4.
Number 4.
Working is number 4. What did this say was it? Non-controlling interest.
Non-controlling interest. Acquisition.
So we are saying non-controlling interest at acquisition. LCI at the acquisition. You remember that one which is down there, the 200? We just pick that one.
200.
Then now, this is where the trick comes in.
Yeah.
Post-acquisition.
Post-acquisition.
You are the one who came up with this one, the 180. You remember?
Oh, the 180 is.
Yeah. So if you add, you add that one,
Add those.
to how much?
Comes to 260.
Even that is 28. Let's go to working 5.
5, eh?
Which is group retained earnings.
Retained NP. So we just get the retained earnings from the parent.
Now it has gone. We took snapshots.
Yes, I took also. Let me just see. We get from the parent, they all wrote 100%.
So and the parent, the 800, isn't it? Is it the 500 group retained earnings?
Yes, from the parent.
So we get 800, parent 100% plus. So 100% is 800, isn't it? Then plus, in a difference,
yes,
times 75%.
Times 75.
So which is 300 times 20% now.
Yes. Not 75 now. 300
no,
times now.
80
oh, only 8. No, but 80%, eh? Oh, yeah. Yes, mixed up.
Which is even better to be mixed up that way because we are remembering.
We are remembering, yes.
Yes, 80%. $240, huh?
Yes.
So 1040. 1040. Now we go to okay, it's done.
Done.
So here it is 800 and plus 300.
Kulepa kufuma pakupita mu revision kitu pia konkama consolidation.
It gives us 1040. Then we go to what is the next one? Working 5. Okay, up, huh?
Yep.
So are there any other tricks that we have missed out from here? Maybe not to our knowledge, is it? Then he said you should now consolidate.
Oh, so it's but now we consolidate now, guys. Nobody
Yes, so that
a screenshot.
we can now consolidate so that we put now the assets we add across the board, isn't it?
Mm.
The non-controlling assets, 100%.
Mm.
Statement
A
of
screenshot
financial.
a screenshot in that time.
Oh, you didn't have. Let me
Mm.
see if I can send this to you. I can share on WhatsApp.
WhatsApp, yes. If into kanshi coach tafenani ba coach finga ba pisha mu fe ama meja ene.
But still more coach mukali not to kwanga. Because the way he handling this, we have been with Jimbukuma, it's something else. I can't see you on WhatsApp. You have a WhatsApp number.
Ni 1979 78 04 any na data ninja shana kwashi. Lesinga chakwa tunaiva depleted, but I should have.
Okay, I can see it.
Okay.
Hello. Yes, I know it's the one. Okay. The hello has come. So now I can send the
Achiri kwacha fakati wa kochi ngatwa konkanya pofya every day apa kuti ava we know. Because
you've gotten the snapshot now.
Yeah. I'm trying to connect.
Let's not live in the past. We can still make it going forward. Last week passed, so let's just move on. We are able, we're more than able.
Network.
There's a problem. Okay. Network. Are you done?
You have seen it?
We are done to share for last but we start from about we start working 5.
We can stop here. Meet tomorrow at after 17, and we'll look at intra dealings. That is what we'll look at, and group accounts. But go to your exam questions and try to use this 5-staged approach that you have learned. Master it. It makes work much easier. So we can check out. So I'll first start with Sidin. Sidin, check out. Tell us your experience today's lecture.
Fantastic. This is fantastic. It makes us open the horizons, especially fair value. The fair value item is critical for me. That was the carrying. Then also how to compute I think the biggest issue is the working number 2, the net assets and subsidiaries. This one, this is where the whole thing is emanating from. Yeah, the computation of goodwill, okay, but the biggest thing I've carried is the working number 2, the issue of fair value. Okay. It gives me a lot of hope for tomorrow.
Yeah.
The computation of retained earnings was very confusing all along. Yeah. So I think I'm set on this. If there are no other tricks apart from this, I don't think this would be a problem.
Sure.
Yeah.
Sure. Ernest?
Okay, here
Yes,
goes.
this I've gotten something like on this format where we have to master this one. It will be easier. It's where on the start with the group structure.
Yeah.
I can't really rap, but I can
Yeah, all
rhyme.
those
Here's my ode to search.
appreciated.
I love to search.
And
I
then
cannot lie. I'll search
fair
at home.
value.
I am not shy. Search for
Yes,
pictures. Search for pie.
Because most of the time we lose marks.
At least I
Like
try.
as you said, just on the you start from strategically on the group structure, you understand the way the
Happy to help.
information is flowing.
Sure, sure.
Because you can be given information the way it's there, but if you don't have a standard way of doing it, you can end up with like the exam was okay, now I was failing to. But when you strategize, you follow procedures like you are technically taking us through it to help us a lot.
Okay, thank you so much. Guys, start checking your exam questions. Try to just attempt. Don't get scared.
Yes. Yes.
Look at the questions. After you're done, go to your suggested solutions. Just check whatever errors you are making. You amend that. So that as we move on, you're also looking at these exam type questions. It is very easy to pass financial reporting. You just have to be structured in the way you do things. Thank you so much. See you tomorrow. Bye-bye.
Oh, thank you.
Google.